Mike, and I'm the Chief Investment Officer here at Lighthouse Financial Services, here with another edition of our monthly market update. So I'll share my screen now, and we'll begin. So September 15th, 2023. Here's our agenda for the day. Okay, are we out of the woods yet with this bull market that's affected stocks, bonds, commodities, the whole kit and caboodle? Okay, so stocks and bonds look to have bottomed last October, but what are we pricing in? In other words, what future expectations are we betting on when we see stocks rising and bonds rising in price as well? We'll talk about interest rates, whether they've topped out or not. The Fed's policy rate is now at 5.5%, and we don't think that will move much higher. I'll tell you why. One of the reasons that the Fed doesn't have to keep raising rates is that inflation is down, but I'll also point out that the prices are still high. You know, I mean, whether it's auto repair services or auto insurance, or I don't know if you've gone out to eat lately, prices are still significantly higher, like in some cases 25 to 30% higher than they were pre-COVID. So it's one thing to have, you know, the rate of inflation slow, which is great. So prices aren't getting worse, but we're still a step function higher than we were pre-pandemic. We'll talk about what normal looks like in terms of interest rates, and then get to the economy. And I think my take is, well, so far so good. Remember, we were supposed to have been in recession by now, and that hasn't happened. So growth, it turns out, this year picked up just when everyone expected it to stall, and we'll explain that in a little more detail. Good thing is consumer spending is a little slower, but it's stable, and that's really what drives our economy. And so with all this new information, you know, we'll reassess the economy's likely landing. In other words, with this tough situation that we've been through, are we looking at a recession coming soon, or are we going to avoid that worst case scenario? So whether you like it or not, and it seems to me that the news media does not like it, welcome to the new bull market in stocks. You can see it on the right-hand side of this screen. I've highlighted the bear market bottom of October 2022, and I mean, you can't argue with it. Since it's been 11 months now, the stock market has been unevenly rising. Both the Dow and the S&P 500 and the Nasdaq as well has a great recovery. So what are we building in here, and why did this happen? Because remember, at the beginning of this year, everyone thought this is going to be a recessionary year. It's just going to be more pain. It's going to be doom and gloom. So it looks like to us the stock market has been telling a different story. It's been saying, look, things aren't as bad as you think, and the worst case scenario is probably off the table. Here's a big reason why the stock market was able to recover this year. Great expectations. This chart line shows S&P 500 earnings per share or profit expectations as set forth by Wall Street strategists and analysts. And on the left-hand side of this chart, you see it's all doom and gloom. This is Wall Street pricing in worst case scenario. We're going into recession. Corporate profits are going to, you know, tank, and that was during last year, and then through the first couple of months of this year. And then in late February, you can see that chart bottom. And after that, I think it started to occur to everyone that, well, maybe things aren't as bad as we thought. And so they started ratcheting up their expectations for corporate profits. It's a pretty steep recovery. It started off pretty tentative, and over the last couple of months, it's been fairly steep. So look, if corporate America is not falling apart, then, well, probably the economy is not falling apart either. Now to the bond market. So, you know, it looks like the worst may be over for bonds. You can see that the bond market started to correct back in 2020, and 21% That's pretty huge for bonds. Their bonds are known generally for being much safer and less volatile than the stock market. But I mean, looking back, I guess, bonds got far too overvalued. Back then interest rates were low and the environments changed. So we had a reset in value. Bonds are a lot more attractive these days, which means that they're paying higher interest yields. But after the October 2022 bottom, the recovery has been sort of less convincing, I think, and on again, off again than with stocks. And that's because we're all trying to figure out, well, how high do interest rates go from here? We're not really sure. And so I'd like to point out the Federal Reserve's policy interest rate history. And this goes all the way back to the dot-com bust in 2001, 2002. But you also see a spike up in rates before the great financial crisis there in 2007 and 8. And then I've circled in red our current, what they call rate hike cycle, or the current policy cycle that the Federal Reserve is engaged in. They've taken interest rates up from almost nothing, almost zero, to about 5.5%. And you can see it historically. That's a pretty high level. The Fed considers that restrictive. In other words, that level is expected to retard economic growth at 5.5%. So this is not a permanent thing. They're just raising interest rates high enough to a level where they think they can get the economy from overheating, and specifically, and more importantly, they're trying to prevent inflation from taking off. So they want to push it back down to what they consider its long-run target of 2%. So that's where we are with Fed rates. Do they continue to raise? We don't think so, but they're sort of cryptic about that. It's hard to say. We think that based on success they've had with inflation so far, that there's not a whole lot of need right now to raise interest rates further, but it's likely that they will keep them at this elevated or restrictive level for a while. So tighter financial conditions, that's what we call this, because anytime you constrain credit in our economy, you're constraining growth. And so here are kind of some outcomes of this tighter financial environment. 2 years ago, mortgage rates, the average 30-year mortgage rate was less than 3%. Now it's 7.7%, as you see on that left-hand chart. And maybe 3% was not normal historically, maybe 7.5%. It is more normal when you look back in time, but that's a shock in 2 years to run rates that high in such a short period of time. The right-hand chart just shows credit card rates, and I think the important takeaway here is that over the span of 1 year, credit card rates went from 15% to 20%. So lending rates across the piece for consumers are higher, and you would think that that's going to constrain consumer spending and therefore the economy. I think it's the same thing on the corporate side. What we're seeing here in this is a survey by the Federal Reserve, is that the banks are tightening standards for loans in the upper left, and then the lower right, that's leading for lower demand, significantly lower demand for commercial and industrial loans. And that's a natural outgrowth. Now, the good thing is, as I said earlier, inflation's coming down. So the blue line here is wholesale inflation, and the black line is retail price inflation. These are year-over-year changes. You can see that the mid-2022 is where inflation peaked out. That black line was about 9% growth over 1 year in prices, and that's really high for our economy. As I said, the Federal Reserve's target is 2%. So where are we now? Well, the Fed rate hiking cycle did take inflation down meaningfully. We're not all the way there, but we're most of the way there. You see, though, on the end of this chart, how both of those lines sort of tick up. And that is why we believe the Fed is probably going to keep rates at this current restrictive level for a little while. They want to make sure that inflation is headed lower. They don't want it to reaccelerate on them, and that that's a risk. because the longer the Fed keeps interest rates at this restrictive level, the more vulnerable the economy is to some kind of, external shock. We've been through a couple of those during this cycle. Remember in March, we had that mini banking crisis, which thankfully was averted only because the government decided to step in and make everyone whole. But those are the kind of shocks that you get vulnerable to when rates are this high. The economy has accelerated in 2023, and that has been, I think, largely unexpected. And so the end of this chart, this is economic growth and year-over-year change in the growth of the economy, or what they call gross domestic product. Anyway, you see at the end of this chart, it hooks back up. Well, that's this year. The first 2 quarters of this year, I think quarter over quarter annualized, we're growing like 2% or 2.1%. And this third quarter that we're about to end is probably going to be stronger. So, what gives? Why? I just showed you that, financial conditions are much tighter, that demand for loans is falling, and lending rates are really asking a lot more of both households and businesses. Well, I think this is one of the big reasons. Going back to COVID, the government threw a lot of money at us, at businesses and at households. And this chart shows that period from 2019 to the end of 2021, and it's dollars. I want you to look at the red and the orange lines. Those are lines representing government spending, and you see they spike, right? And they're even labeled. These spikes are labeled round 1 stimulus, round 2 stimulus, round 3 stimulus, and the red line is specifically just money that was thrown at us because of COVID, whereas the orange line is other government transfers like enhanced unemployment benefits, things like that. But the important thing is, at each of those spikes, those 3 spikes, you see that blue line spike up. That is the consumer savings rate. And what that means is that each time they threw money at us, we put it in the bank. And there's other data to confirm that most consumers use that extra money to not only save more, but also to pay down debt. So, corporations do the same thing. You remember those PPP loans. So that just shows me that, coming into this difficult period, we had some extra financial cushion, which is great. One other reason that the economy and specifically consumer spending have kind of hung in there, I think it has to do with the wealth effect. And what this means is, as the value of your assets goes up, you kind of feel better about things generally, and you're probably more likely or willing to spend money. On the other, so if your home value is rising, and that is the case, although the housing market was supposed to crash, it didn't. Home prices this year are on the rise still, and so are 401ks recovering again. So household assets are rising in value. Liabilities are rising, but not as fast. And as I said, a lot of consumers used the stimulus money to pay down debt. So this chart's showing you that household net worth across America is close to a record, and I think that helps explain this chart, which is that consumer spending is doing just fine, and you're not going to read that in the financial news headlines. That just doesn't get a whole lot of play right now. I think a lot of the financial news reporters are ignoring this, but you see in this chart on the left-hand side, consumer spending really fell off at the very end of 2020, 2021, and the beginning of 2022. The economy was clearly overheating, and inflation was really taking off, and the Fed was threatening to take interest rates much higher. And so spending sort of took a hiatus. But since then, since March of 2022, we have seen not just a stabilization, but sort of an acceleration of consumer spending. And by the way, this line is already adjusted for inflation. This is real consumer spending. So I lifted this quote from the Wall Street Journal yesterday. Americans are spending like they think tomorrow is going to be all right. And the title of that article, I think, was don't bet against the consumer. So this is pretty clear it's a pillar of our economy, a pillar of strength right now, that consumers are feeling okay about spending money. Incidentally, we just got another piece of corroborating evidence this morning. The University of Michigan does consumer surveys every month, and they're aimed at figuring out how people feel about the current environment, and then into the future, and how they feel about inflation. And those numbers were sort of all a little bit better, except where consumers noted that the price of gasoline is really rising again. So, as I said earlier, there are still some risks here. I don't know that we're all out of the woods, but you just can't ignore this resilience in the economy. All right, so we're going to reassess the likely landing for the economy and capital markets. And I think I first showed you this chart a year ago, or this slide. When you have the overheating economy and inflation spiking to multi-decade levels and 40-year highs, and the Fed threatening to choke off economic growth with much higher lending rates, you've got to think, well, where is this going to end? And I want to back it up even before that. COVID screwed up our social patterns, financial patterns, the way business was conducted, and we are still trying to find our footing. We're trying to return to normal, and the pendulum was swinging, wildly during the period of 2020, 2021, and now we're trying to find normal. And that period, that transitionary period toward normal, obviously is going to cause trouble in capital markets and the economy, and there have been some shocks. We told you a year ago that we thought a bumpy landing was probably the most likely scenario. In other words, we're going to get some shocks that are going to push your investments all around for a while, but in the end, it's going to be okay. I think over the last year, the data that we've received show us that we can probably rule out the no landing scenario, which means everything's going to be fine, don't worry about it. But we can also rule out the hard landing, which is the severe recession, sort of like the great financial crisis in 2008. So if that's the case, then we're left with sort of the middle scenarios, which is either a soft landing or a bumpy landing. The soft landing has been seen as nearly impossible, and there's good reason for that. I mean, typically in the past, when you have a situation like this, the Federal Reserve just cranks up interest rates and tightens financial conditions to the point where they end up choking off growth, causing a recession. Now, the good thing is, of course, that's going to drive down inflation. Great, but the bad thing is you're putting a bunch of people out of work. Businesses are declaring bankruptcy, and it takes some time to climb out of that. We don't think that the severe recession is a probable outcome this time. We didn't think that a year ago, and we still don't think that. And I'm still leaning toward a bumpy landing. I think there are still risks out there, and the primary risk is that if the Federal Reserve continues to keep their foot on the brake, eventually they'll break something in the economy. Eventually they'll choke off economic growth. And so I think that's a key thing to watch. But at the moment, with the data that we've seen, it's really hard to say that a severe recession or even a recession is imminent in the foreseeable future. So I think this is probably the time where we continue to be invested and just monitor things very closely. I want to thank you for listening to our market updates, and thank you again for being our clients. Have a great day.